Good afternoon, everyone. Trust you're having a good day. We welcome you to our webinar series. We want to first of all thank you for always tuning in whenever we beckon on you. And then we'll also like to, keep you informed about the financial market review. So for this particular series, we're going to first of all look at the half-year 2024 Nigeria Economic and Financial Market Review, and then the outlook for the half year, which is the remaining half year, which is from July to December. We want you to be able to make your investment decision based on strategic opportunities, based on the economic landscape, and then to also discover key insights and data-driven forecasts that would help you. So, having said this, I would also like to inform you that the webinar series, the webinar session is going to be a 40-minute duration, after which we would have a 10-minute session for question and answers. For your question and answer, it can be done in two ways. One, you can either make use of the question and answer button where you can input your questions, or raise your hand using the button and we would unmute you to speak. Afterwards, we'll then have another 10-minute session where we would talk to you about Cowrie, our product offerings, and the available opportunities you have. Thank you very much. So I would like to welcome our GMD, Johnson Chukwu. Over to you, sir.
Thank you, Roger. Good afternoon, everyone, and good morning for those of us outside the country that I see morning hours to you. Once again, it's a pleasure to speak to you on our quarterly webinar to basically dimension the economic direction of the country and the world in the immediate past quarter. But because it's the beginning of the second half of the year, we'll be speaking entirely on what happened the first half of the year. And then we will try to speak on what we think. We try to hazard a guess on what we think will happen in the second half of the year. Of course, we are not talking to post, but we will try to, as much as possible, to speak to based on our understanding of the economy. I can see some people are raising their hand. Dr. Kabir Hamzat, you can post your question on the question chat. I think two persons have raised their hand so that we can just quickly take through the presentation and then we take all your questions. I also see Joel Haruna has raised his hand. Please, if you post your question or if you have any challenge, post on the question and answer section on the comment section. Somebody will address those challenges in case maybe you are not able to hear me or you are not seeing the presentation. My colleagues will immediately attend to you. Once again, I'll be speaking on the half-year 2021 outgone first half of the year. I will speak on what has happened in the global economy. I will try to speak on what has happened in the Nigerian economy, and I will try, like I said, hazard a guess on what I think we're going to or what will happen in the second half of this year. And then I will take your question for 10 minutes. Well, we know that the global economy, like somebody said to me in one of our conversations, that the global economy has completely changed since the COVID era. And simple thing that happened was that during the COVID era, virtually all countries in the world entered into a quantitative easing period. And what they did was that they began to release a lot of liquidity into the economy, into the economies. And that led to a major boost of what we call liquidity surplus. And that liquidity surplus led to an increase in prices because at the point we had the COVID era, virtually all the countries locked down their economies, and then productive activities slowed down to a halt. And then you had liquidity being injected by ways of handouts, cash handouts to households, support for companies, and then that was not supported or counterbalanced by productive activity. So you had what the simple economic definition of inflation is, when excess liquidity is pursuing few goods. And that led to so much of liquidity injection into the economy. And we saw by the time the economies began to open, there were still supply bottlenecks either created by China that didn't open up on time, and subsequently we had a war in between Ukraine and Russia that further constrained the supply chain, particularly supply of energy resources and supply of food. So we had a high food inflation, high energy inflation, and then the monetary authorities globally have been trying to fight inflation across the globe. And of course, we saw following that lockdown, we saw a slowdown in economic activity, global economic activity. We are concerned that most global economies was going to go into recession. So in effect, what the economy has been doing is trying to reset the order of economic activities, to normalize the inflation rate, to restore economic growth over time. So so this is just about me, but it's not all about me, it's about you, and it's about how the economy affects you. So we're going to take a quick review on the global economy. The global economy in Q2 2024 actually remained on a recovery path. Like I said earlier, the world economies have been trying to recover since the COVID era. So that recovery continued in the second quarter of this year. We saw that global recovery progressing, but at a slow rate. We saw economic performance quarter was spurred by a couple of things that happened in Western economies. We've seen gradual recovery of consumer spending or consumer confidence. We are seeing a decline in inflation rates back to the levels, some countries to the levels a year before the COVID-19 crisis. So the key thing that the central banks of the world were trying to do was fight inflation and restore economic growth. And you know that those things don't go hand in hand. When you put measures in place to fight inflation, what happens is that it leads to slowdown in economic growth. And for you to have both at the same time is a difficult thing. But good thing is that we are seeing a moderation in inflation across the globe. We're seeing inflation coming under control in US. We're seeing inflation coming down in UK and in many of the Western economies. But unfortunately, in the developing economies like ours, we are still seeing very obstinate inflationary pressures. So the world economy began to show some level of recovery in Q1 2024. We saw the likes of US grow at about 1.4%, and in Q1 2024, we saw China grow at 5.3%. In Q1 2024, we saw the likes of Russia grow about 5.4%. And we also see that India is also one of the strong growth, actually one of the fastest growing big economies in Q1 2024. IMF is projecting that the global economy will recover better, achieve better this year. They are projecting the global economy will grow at about 3.2%. That is still quite weak, but given where we are coming from, but the challenge we have is that this growth will still be challenged by the issues around Russia-Ukraine war. That war has refused to go. We're still seeing global product activity still relatively weak. And we are seeing global market fragmentation. What do I mean by global market fragmentation? We've seen a Russian bloc that is completely different away from the Western countries. We've seen the South countries trying to create an economic bloc away from the Western countries. And then we are seeing slowdown in global trade because of these fragmentations. We know that Western countries will not allow you to buy Russian refined oil, and Russia is also threatening to retaliate. We are seeing a stronger relationship between Russia and China and stuff like that. We also see that the US have tried repeatedly and unsuccessfully to impose restrictions on Chinese technological advancement. The interesting thing about it is that the more effort that the US is trying to constrain China's technological advancement, the more the Chinese are evolving their own indigenous technologies to overtake or at least compete with what the US has. You know about Huawei. US are trying to impose so much of restrictions on chipsets and software sales to them or exchange with them, and including restricting their market access to the US market. But it doesn't seem to be working. So, but in any case, any constraint to global trade slows down global economic activities. The US is expecting that advanced economies will grow at 1.7% in 2024, up from 1.6% growth in 2023. But interestingly, the global inflation is moderating. It's expected, the global inflation is expected to decline to about 5.9% in 2024, down from 6.8%. I had said earlier that we're seeing countries like the US, UK, seeing relatively strong moderation in their inflation rates. Then in terms of global productivity, the S&P Purchasing Managers Index is expected to remain positive, reaching about 50.9%, driven largely by improving manufacturing and service sector outputs. However, selling price inflation remains a constraint. I had mentioned that part of the challenges we had was increase in energy cost. Of course, the increase in energy cost has a direct input cost. In terms of regional performance, Asia will lead in improvement in productivity. Asia includes countries like Japan, China, India, and as it stands today, India and China are the hub of productive activity, including the likes of Vietnam and Thailand. All these are Asian countries, well as Western countries like US and UK will lag behind in productive activities. But I also need to mention at this point that the US is actually living up its productive activities, principally because the US has been able to adjust sufficiently its economy because of the advent of shale gas. US has actually weaned itself from being a net importer of crude and net importer of liquefied natural gas to a net exporter of crude and net exporter of liquefied natural gas. As we speak today, US is already exporting LNG to China. What has that done for the US? The US economy had become productively competitive, unlike what it was before. Companies are migrating away back from China, back to US, away from China, back to US, because the reduction in energy cost in US is offsetting the high labor cost that drove them to China. And that simply means that US economy will continue to grow and even grow stronger in the coming months. Of course, we've seen the US Reserve Bank is about starting dialing back on its quantitative tightening. But we still, if you see the increase in May, it was only 25 basis points in the benchmark rate because they saw a spike, an unexpected spike in inflation rate. They are currently projecting that inflation will begin to moderate and they will start dialing down or dialing back on the contractionary monetary policies to support economic growth. In terms of unemployment, the US is showing a very low unemployment rate today. Unfortunately, all this have not rubbed up positively on President Biden, but we'll come back to that. England also, the Bank of England also increased its benchmark rate by 25 basis points to 5%. The England economy is still struggling. Of course, we're seeing moderation in inflation rate. We're seeing improvement in employment rates. Unemployment had dropped about 4.4% in England, but that didn't help the immediate past prime minister. The European Central Bank has retained its main refinancing operation rate at 4%. China People's Bank of China rather cut its reserve requirement ratio, that is something like what we call our cash reserve ratio, by 50 basis points. Of course, we know China, there is a threatening real estate crisis, real estate financial crisis, because there was over investment in real estate through leverage that have not been able to be sold. And like I said, we are seeing a migration back from China to the US. So the pressures or the demand for those real estate investments is weak, and those companies are not able to pay down. So the Chinese Central Bank, or what they call the People's Bank of China, is doing everything to prevent a financial crisis, and that's why they had to resume the reserve requirement ratio of banks in China. Japan is still in a negative yield environment at 0.1%. The other things that should be of interest to us is what happens in the global oil market. Of course, we know that our major exports, about 90% of our total exports is actually coming from crude and liquefied natural gas. So whatever happened in that space is of critical importance to us. The oil industry in the first half of the year was quite volatile. The market oil industry started with a Brent price of $75.91 as of January 2nd. It peaked at $90.34 per barrel on April 15th, and it gradually declined back to about $78.16 on June 3rd. We are seeing in the range of $80 now. The International Energy Agency had actually projected that demand will grow to about 2.2 million barrels a day this year. But interestingly, they have revised that down to 1.1 million barrels a day, and that has further been revised down to about 900,000 barrels a day. Why are they revising this? One is that the major sources of demand for oil has turned and become an exporter of oil. Two, the expectation that the global economy will grow at a faster rate is not materializing. And then three, we are seeing a shift in energy source away from fossil fuel. We are seeing an unprecedented increase in the viability of alternative energy sources like wind energy, EV vehicles, that is electric vehicles, and we are seeing even solar energy supply is also reducing the demand for fossil fuel, and that's why International Energy Agency has moderated its projection on increase in demand from 2.2 million barrels a day to about 1.1 million barrels a day. Even the increase we are seeing in production is coming, crude production coming from non-OPEC members, non-traditional crude exporters like the US. The ongoing war in Ukraine has also continued to disrupt supply chain to higher, and therefore has kept energy prices higher. I just mentioned now that we are still witnessing a Brent crude of about $80 now. Remember, our budget was predicated on a far less, I think about $78 per barrel. I had mentioned earlier that many of the emerging and developing economies who continue to rely on energy supply will still have to contend with higher prices because of, one, the geopolitical tensions. Of course, we know the major export channel for crude from the Middle East countries has continued to be under threat as a result of the ongoing war between between Hamas and Israel. Now, looking at inflation, you can see the graph to your right. You can see how Nigeria is faring in terms of inflation rate. We see an inflation rate at 3.95%. Nigeria's inflation rate is one of the highest of the relatively big economies, unless you want to throw in Congo Democratic Republic. But if you exclude the likes of Congo Democratic Republic, you can see we are even, I didn't put Ghana here, but Ghana, we're even currently higher than Ghana in terms of inflation rate. In terms of global trade, we saw an increase of only 1% in global trade quarter on quarter, principally because of increase in trade between China and India, as well as US. These are the major sources of global demand and global production today. Now, speaking about the global economy, this was a quote. It wasn't actually an original quote. Bill Clinton was not the one that invented it, but it's mostly ascribed to Bill Clinton. We are seeing a global economic environment, which I said had been distorted since the COVID era, that created a new normal in the global economic environment, injection of liquidity by central bank without productive activities, efforts to withdraw those liquidities that has led to collapse. I mean, the liquidities led to increase in inflation rate, increase in inflation rate led to weakening in consumer demand, led to cost of living crisis in many countries in the world, and the central banks have been trying to resolve that. So the politicians are taking the rap for this. And that's why when Bill Clinton quoted that his economy is stupid. If you look at the next slide, you will observe that a lot of politicians are taking a rap. On your top left corner, that is Sunak and Starmer. Of course, despite the fact that I said the inflation rate is moderating in England, unemployment rate is moderating in England, the English people booted out Sunak and brought in Starmer, principally because of the economy. Like I said, the world is going through a cost of living crisis in most countries in the world. If you speak to your relations who have jackpot to England or any of the Western countries, they will tell you how tough it is to make ends meet. The last time I went there, I realized most people have moved out of what they call central London into the northern and southernmost part of England because they can't afford the rent in central London. And then to your right, you'll see also a likely tsunami that will sweep out Biden. Biden, despite the improvement we witnessed, the US economy have witnessed, has still not been able to get the support of most electorates. It won't be surprising if in November, when the election is held, that Biden loses in the election, despite Nigerians' aversion to Trump. But it's looking likely that Trump will win unless, I don't even know if Biden withdraws today, whether it will make any difference. And then look at in France. We're also seeing a major shift in political activities. We're seeing a trend where the president of France is likely going to lose the election. And then down there, you will see another cost of living crisis and issues around corruption and government expenditure affecting activities in our sister country, Kenya. So what does this tell us? It tells us that the cost of living crisis globally can be a spur for a change in government, can be a spur for social unrest. And that's why as we move to the Nigerian segment of this presentation, we believe the government people should be conscious of the fact that the cost of living crisis, I think I've seen some comments recently where the National Assembly is worried about the cost of living crisis and advising the president to do something quickly to improve the cost of living, to reduce the cost of living crisis and avoid a possible upheaval. I also saw a comment by Senator Adams Oshomole where he made a reference that he wasn't sure that the president wants to continue in 2027 if he allows the level of deterioration in standard of living to continue. But now let's go to our economy. What has happened in the economy in the past 6 months? Our economy grew at 2.98%. Compare this to 3.46% it grew in Q4 2023. This was a deceleration or a slower growth in the economy. And why do you have a slower growth in the economy of this size? Because some of the major drivers of the economy are growing at a very slow rate. Look at the agricultural sector. Agriculture accounts for about 21% of the GDP. Agricultural sector grew at only 0.18% in the first quarter of this year. And it shouldn't be surprising to us that we're having the kind of food inflation at 40.66%. If agriculture that accounts for 21% of the economy is growing at 0.18%, that's almost a nil growth, and the population is growing about 2.4%, it then means we're adding more mouths, we're not adding more food. So unless you substitute or you import the shortfall in food production, you are certainly going to have a high food inflation, and a high food inflation has a negative impact on cost of living standard. So we see the economy grew at only 2.98%, a deceleration, like I said earlier, from a 3.48%. It grew in the fourth quarter of last year. Then in terms of what are the sector that drove the economy, we saw the service sector was actually a major contributor to the growth of the economy at 4.3% growth rate and contributing 58% of the total GDP. The oil sector, interestingly, has resumed its growth because we saw crude production at about 1.57 million barrels a day, an improvement from about 1.55 million barrels a day in recorded in Q4 2023. So we've seen oil sector resume its growth and grew about 5.7%. But then the non-oil sector, the entire non-oil sector grew at only 2.8%. When you bring in the likes of agricultural sector, the manufacturing sector that grew at 1%. Interestingly, it's also good to mention at this point in time is that the public sector expenditure, because when you have a slow growth in the real sector of the economy, it can be offset by public sector expenditure. But we also believe public sector expenditure will come under pressure because crude production had remained weak and have not achieved the 1.78 million barrels a day we had projected, and then debt service is rising. So in terms of the distribution of our GDP, I always make this statement that our economy is relatively diversified. What is not diversified is our foreign exchange earning source. If you look at the pie chart on your right, you realize agriculture accounts for 21% of the GDP, information and communication technology 18% of the GDP, trade 16%, manufacturing 10%, finance and insurance 7%, mining and quarry 6%, and you have like and on and others 10%. I need to re-emphasize is that telecommunication sector is one sector that has proven to beyond all reasonable doubt that if you get the policy right, then you get the sectors of the economy growing. It was because of the licensing of the to GSMs at the very transparent method that in 2020 or so, 2000, that led to an inconsequential sector of the economy becoming the second largest contributor to the GDP. But unfortunately, that sector's growth rate is slowing because government also seems to have taken its eyes off the ball. So I had mentioned the issue around agricultural sector that only grew at only so these are the sectors, the sectorial growths and their contributions. You can see agriculture almost a nil growth. You can see ICT sector growing at 5.4%. And ICT sector, like I said, is the second largest contributor of the GDP today. At some point, it will grow about 13%. So we need to ask ourselves, why has this slowed down its growth rate? There was issue of tariff recently. And when they wanted to increase their tariff, and people went to court to start them increasing their tariff. But anyway, that's the topic of another discussion. You can see the financial services sector growing about 31%, counts for 6.8% of the GDP. The manufacturing sector accounts for 9% of the GDP, and we only at about 1.49%. Trade grew at 1.23% and counts for 15% of the GDP. So let's look at where we are when it comes to issues around our trade. In terms of our trade with external parties, Nigeria's total trade in the first quarter of this year was 31.8 trillion naira. Of that amount, 19.16 trillion naira was our total export, and our total import was 12.95 trillion naira. So for the first time in a long time, we had a positive balance of trade of 6.5 trillion naira. When you have a positive balance of trade, it then means that bearing in the absence of any other factor, that you will begin to accumulate reserve, and therefore you are in a position to meet your obligations or arrest obligations that they come due. So for the first time, like I said, we've seen a positive balance of trade in a long while. But when you now decompose our trade activities, you will now see that, which is important to all of us, what are you actually exporting? So you can see that 81% of total export was export of crude. Then when you add LNG of 9%, so effectively 90% of our total export was coming from fossil fuel related activities. And that's why we said, in terms of origin earnings, our economy is concentrated and is highly limited to export of crude. Our foreign earnings coming largely from export of crude. 90% is coming from export of crude. And then in terms of imports, we're importing 32%, and we're spending 30% of our import on petroleum or petroleum-related products. If you look at the pie chart at the lower end of the graph, you will see that ordinary motor spirit, which is petroleum motor spirit, fuel, we spent 2.63 trillion naira of the 12 trillion naira we spent on imports on fuel, and that accounted for 21% of our total import. Gas oil, which is AGO, diesel, we spent 1.2 trillion naira, and that accounted for 9% of our total imports. If you add those two, you're already at 30%. So in effect, we spent 30% of our total imports on importation of fuel and importation of diesel. And then even you add the LPG and other gases, you spend another 190 billion on those imports. So that gives another 2%. When you add that, you are spending about 32% of our imports on fuel and gas. Then when you add the other things like bitumen, you get 35% of our total import. These are products that we produce the raw materials. And in effect, what that says is that should Nigeria develop economy to the extent that we can domesticate our refining and our crude production and refining productive activities, then we're going to save 35% of our total amount we spend on imports. And that will have a direct impact on our foreign exchange reserve, direct impact on exchange rate, and direct impact on the inflation rate. Now, let's quickly look at this stock. I just prepared over this because I'm sure many of us are very familiar with the fact that our total national debt has increased to 121 trillion naira at the end of March this year, the first quarter of this year. But I need to do something that many of us have not bothered to do. If you look at that DMO figure, which shows that Nigeria is facing an escalating debt crisis, total debt rose by 24.33 trillion naira in a period of 3 months. And then the dollar equivalent of our total debt is 91.46 trillion. Why we are saying naira equivalent increased by 131 from about 97 trillion to 121 trillion. You're also saying that foreign currency value of the debt has dropped from 108 billion to 91 billion. So sometimes government has said we're seeing an improvement in debt situation. And I said, look, let's look at this fact critically. If you look at this fact critically, you will understand that our total debt, total local currency debt, was actually increased from 56 trillion to 65 trillion. So total local currency debt, without converting using a higher exchange rate, actually increased from 56 trillion in December to 65 trillion, an increase of about 6 trillion, about almost 7 trillion. Remember that the federal government had borrowed additional 7.3 trillion naira from the federal government, which were securitized and added to the national debt. And that's why you saw that increase in local currency debt. So in effect, the reduction we saw in dollar value of the debt was not genuine, was only a matter of exchange rate shift in exchange rate. In effect, because if you look at our foreign currency debt, the foreign currency debt was 42.115 billion in March 2024, a slight reduction from 42.495 billion in December. So it's still about 42 billion for those 2 periods. So the change we actually had was that increase of about 7.3 trillion naira, which was Secretary of Ways and Means. So in effect, let's not get confused and believe that our total dollar value of our loans reduced. What happened was when you converted the 65 trillion naira at a higher exchange rate, then it looked like the total dollar value when you converted the naira debts into dollar. Well, this is just to show you that, yes, we say we are not yet in a debt crisis, but we are building towards that. We can see on the bar chart to your right, we've seen our debt to GDP ratio has now gotten to 49.51%, almost 50%, about 50%. We're not able to 50% debt to GDP ratio, but the concern should be the debt service. Our concern should be the debt service. So if you look at our total debt, you will realize that of the $42.1 billion, the federal government owes multilateral agencies about $20.83 billion, which is about 49% of foreign currency debt. Who are these multilateral agencies? The likes of World Bank. We owe the World Bank $15.587 billion. We owe IMF $2 billion. We owe African Development Bank Group $3.2 billion. Then we have our bilateral partners. We owe China $5 billion, and then we owe France about $652 million. In effect, total amount we owe our bilateral partners about 5.9 billion, with about 14% of foreign currency data for the $42.15 billion dollars. But the concern to you should be that we have commercial loans of about 15.118 billion naira, where we are paying commercial interest rate about 9% or close to 10% that the federal government borrowed by way of Eurobond. Then if you look at our local currency debts, of that 65.65 trillion that we owe, federal government owes about 61.578 trillion. And a large portion of that, about 78% of that, is on bonds that have long maturity, very long maturity profile, in the region of 20, 30 years. I'm sure this is a fact, what would interest anybody who is listening to this program, the issue of inflation rate. The cost of living crisis we are facing today is coming because of inflation. We are now dealing with a 28-year high inflation rate at about 33.95%, an increase from 33.69%. So the May inflation rate came at a print of 33.95%, almost 34%. The major challenge we have is that if you add the fact that by May last year, total inflation, all item inflation, that is the composite inflation figure was 22.41%. So you know that in the last 2 years, the country has the value of your purchasing power, the purchasing power value of your income has been eroded by about 56%. So in effect, more than half of what you can afford, more than half of what you were affording 2 years ago. And when you talk of food inflation at 40.66%, and then when you add the food inflation at 24.84% May last year, then you are dealing with 2 years inflation figure of 65%. So in effect, for those whose income have not changed in the past 2 years, they can only afford about 35% of the food they used to afford with their income. So when this drives home that you now realize that, so why am I feeling this impact? The truth is that if your salary has not increased in the past 2 years, between May 2022 and now, and you're earning the same income, that income you're earning can only buy 35% of the value or the quantity of food you were buying before. So when you now say garri is expensive, rice is expensive, so that will now tell you why those things are expensive, what has happened to your income. And to drive home the point, to get you know the implication of why Nigerians are going through a cost of living crisis, the major increases are coming from those staple food items that we all eat: semovita, oat flakes, yam flour, pounded yam, garri, beans, Irish potato, vegetable oil, fish, meat. That's where you have the highest increase in prices of items. And that's why most Nigerian households are hurting. But, well, I don't know whether I'll call it a good news. Of course, we know there's what called base effect on inflation, which means if the inflation rate is already high, subsequent increases will be in terms of proportionality, will no longer be as steep as they were because of the higher base. So we're beginning to see that crawling. We saw 3 months of reduction in the month-on-month inflation. That is, when you compare what changed in between April and May, or what changed between March and April. So you're beginning to see a slowdown in that process because the previous months were already high. And let me put it in a graphical form. If the food inflation, if the price of food, take for instance, a cup of rice is 100 naira today, and then it moves to 120 naira, then you are talking of a 20% increase. If it moves to from 120 to 140, another 20 naira, it is no longer a 20% increase, because you're saying it's now 20 over 120, which gives you an increase of something like 14%. So you can actually say at that point that inflation had dropped from 20% to 14%, when in actual fact, the increase was of the same magnitude, but in terms of proportion, it's not the same effect. So that's what we'll be witnessing as we move forward in the coming years. So this is when I mentioned this earlier, that if you compare yourself to your peer, these are African peer in terms of inflation rates. If you look at the lower bar chart, you will see, apart from Congo, so I'm not sure any Nigerian wants to be in the same league with Congo Democratic Republic, unless you like Daxter Makosa. But otherwise, it's a wrong group for us to be rubbing shoulders with. So you can see, apart from Congo, Nigeria, among the African peers, is the highest, the country with the highest inflation rate. Ghana, that we used to say the ordinary Ghana, they have been able to manage down their inflation rate to 23%. Egypt is at 28%, Zambia, and on and on and on and on. So I wouldn't dwell so much on this, because this is just to tell you what the central bank is doing in terms of fighting inflation. It has increased monetary policy rates by 750 basis points from in February, when it was 18.75% to 26.25% in May, and then increased the cash reserve ratio. It increased the liquidity cash reserve ratio to 45%, but the retained liquidity ratio at 30%. Because of time, I need to move a bit faster. Capital importation is one area that would be of interest to us, because capital importation affects the exchange rate stability, affects inflation rates. And then we saw a capital importation that jumped for the first time in a long while to $3.37 billion, up from $1.1 billion. And for an average Nigerian, you would think this is something to celebrate. But when you decompose the capital that came into the country, you realize that of the $3.3 billion that came in, 2.076 billion were portfolio investment. And when you talk of portfolio investment, you're talking of money, people that brought money to buy your treasury bills. About $1.6 billion came in to buy treasury bills in that period, in the first quarter of this year. And the other $460 million came in as loans, to buy bonds. About $460 million came in to buy bonds. So that's summed up about 2.076 billion that was invested. Then you had another 1.18 billion that came in as loans, or what they call under investments. These are short-term investment that come taking advantage of opportunities created by increase in yield on treasury bills. We saw on March 6th, the central bank sold treasury bills at 21.49% coupon. And that was the incentive that drove the sharp increase you saw in capital importation. It may be interesting to you to know that central bank in the first quarter of this year, the first 3 months of this year, sold 6 trillion naira of treasury bills and 2.38 trillion naira of bonds, all in efforts to attract foreign portfolio investment to the economy and help stabilize the exchange rate. Of course, that had a salutary effect on the exchange rate. You know, by April, we saw the exchange rate drop to about 1,000 naira to a dollar, about 1,049 naira to a dollar. But that, unfortunately, has reversed and gone back to about 1,500. The reality is that for any country, your priority should be to attract foreign direct investment. That is investment that is going to be there for the long haul. But only 119 million naira came in as foreign direct investment. The global oil market, I had mentioned this briefly, but it's just good to mention that our crude production has, I had mentioned that it was about 1.57 million barrels a day in Q1 2024. But the key thing we must bear in mind is that prices have remained strong, but unfortunately, Nigeria's crude production has remained weak. Our average crude production is in the region of 1.25 million barrels a day so far, and our budget for crude production was about 1.78 million barrels a day. So while we're enjoying some level of positive price variance, we are enjoying huge negative volume variance, which is impacting on the government earnings. So that's basically what I was speaking here about here. I need to move a bit faster because I'm thinking I'm running out of time allotted to me. Of course, the implication of having a negative crude production variance, which accounts for about 81% of our total export. If you add the LNG, it moves to 90% of total export. So when your crude production drops, your foreign exchange earnings would become weak. And if your foreign exchange earnings is weakened, then your currency will come under pressure. So apart from the inflows that we're used to kind of moderate the foreign exchange pressures, we saw Naira fluctuate widely. We saw Naira trade at 1,900 Naira to a dollar. In the parallel market, an official window about 1,800 in February. Then because of that, Central Bank came aggressively in March to begin to issue T-bills and bonds at very exorbitant yield, which attracted foreign portfolio investors. And then we saw Naira recover. So Naira has witnessed a kind of zigzag movement in the first half of this year. But today, we are seeing Naira trading about 1,540 Naira at the parallel market, and even at the NAFEX window. We also see Naira in the region of 1,000, circa 1,500. But good thing is that the central bank was able to clear about 4.5, some of the backlog of outstanding, about 7 billion of the backlog. Central bank was able to clear 4.6 billion, leaving about 2.4 billion, which they claim were invalid. But I believe they will still have to review that in the near future. Well, these are some of the raft of policies that Central Bank has been dealing with to fight the crisis occasioned by the exchange rate devaluation. I must say this to you people that the major problem we have witnessed in the country in the past 1 year is largely related to our inability to manage the exchange rates. The other factor is our low food production as a result of insecurity in major food base of the country. If we had been able to put a hand on the exchange rate and were able to maintain the exchange rate at about 750 Naira to a dollar when the removal of subsidy was enacted or announced, today would have stabilized the economy. Cost of living crisis would not be where it is today, and probably the economy would have started growing on a stronger note. So you can see the wide fluctuation in the exchange rate on the line graph. You can see when it touched in February, when it touched about 1,900, and at the parallel, at the official window, 1,890. And then it came down when the government became bullish in issuance of bonds and attracted liquidity, foreign currency liquidity from foreign portfolio investors. It came down to about 1,072 Naira at the parallel market and 1,080 Naira at the official window. So now let's look at the markets as I gradually wind down. So we saw the equity market year to date had gained about 33% year to date. Year to end of first half of the year, up from about 18.96% gained in the first half of last year. The investors in the market at the end of June had gained over 15.6 trillion Naira. Of course, Nigerian market in first half of the year had actually performed most of the other bourses. In Africa, it had beaten that of Casablanca in Morocco. It has beaten that of Johannesburg Stock Exchange. It beat NAFDAQ and New York Stock Exchange. But interestingly, almost all the sectors gained other than banking industry. Why was the banking industry a laggard? Not because they were making good profit, because of policy announcements on recapitalization of the banks. So investors were wondering, before the banks were giving up to the end of March to submit their plan on recapitalization, and investors wanted to stay on the safer side and not invest in banking stuff. So of all the sectors that gained in that in first half of the year, industrial goods actually outperformed the rest with that 73% gain. Consumer goods at 41%, oil and gas at 38%, insurance 21%. Like I said, the banking industry was the only laggard. This is just to show you the quarter-on-quarter performance of the all-share index in market capitalization. And interestingly, if you look at this, if you look at towards your left side, you will see in Q1, the all-share index had actually gained almost 40%, and market capitalization gained 44%. But if you look at June, which was the Q2 2024, you'll see the all-share index actually lost, which means the market is beginning to witness correction, just like the market capitalization lost about 4.26%. So the year-to-date gain as at the end of June was a drop from what it was at the end of March this year. And that we'll speak more on because the current policy environment had led portfolio investors to start what they call portfolio rebalancing. Investors are now selling down their variable income assets, which equities are part of, and taking advantage of elevated yield in fixed income space. At a yield, at a coupon of about 20.69%, which is what the central bank is issuing the treasury bills, effective yield is above 25%. So investors are saying, look, am I likely going to get another 25% on equities capital gain? Not likely. Is there any dividend yield about 25%? Not likely. So I would rather sell down equities and take position in fixed income space. And that's why you saw that correction of 4.31% in equity in the Q2 2024. And our take is that will be the trend in the coming quarters. That is Q3 and Q4, that the equity market may begin to shed weight or go on a bearish trend as investors are taking positions in fixed income instruments. Of course, if you look at the equity market in Q2, which is the bar chart on the lower end of this graph, this presentation, this page, is showing you what happened in Q2 2024. You can see all the share index declined by 4.3%. Industrial goods declined by 3%. The only one that gained in all the sectorial indices was oil and gas. And why did oil and gas gain? Because some of these things I also tell you that the impact of policies on economic performance, or the actions of the private sector investors, or actions of economic agents. We saw policy announcements on banking capitalization led to the banking industry being the only sector in the whole of entire H1 2024 declining. And we saw that the government decision to allow Seplat to acquire Mobil, producing Nigeria Unlimited, to allow that or make NNPC to drop their preemptive rights or right of first refusal on that acquisition is what led to the oil and gas sector gaining 11% when other sectors were declining. Of course, the banking industry, many of us are aware that many of them are in the bank market today raising funds, was the worst performer in second quarter of this year. These are just to show you the top gainers and top losers as at the first half of this year. Now, let's quickly look at the fixed income market. We've spoken extensively on this. We saw the central bank in the first half of this year issued treasury bills 8.85 trillion naira and OMO bills of 6.42 trillion naira, well as where the debt manager office came to the market and issued bonds, federal government bonds of 4.1 trillion naira. In effect, the federal government, through the debt management office, and the central bank had borrowed from the economy 19.41 trillion naira between 2nd of January and 30th of June. That's the amount of liquidity that was sucked out of the system within the 6-month period. And that's why you're having a limited year. That's why you're having the banking industry struggling with liquidity. That's why lending rates have gone up. And while at the same time, the federal government, the 3 tiers of government shared between January this year and May this year, the 3 tiers of government shared 5.78 trillion naira This was far above the 3.98 trillion that they shared at the same time last year. So while the central bank is trying to suck out liquidity from the system, the fiscal authority are injecting liquidity to counterbalance the actions of the central bank, which is why you still have the challenge we have with inflation, apart from the part of the inflationary pressure is coming from, or larger part of the inflation pressure is coming from lack of food production. But what we must know is that when liquidity injected by way of FANC, some of that fund find its way into the FX market to buy dollar and put additional pressure on the dollar. This is just to show you what I just mentioned. 19.4 trillion naira had been withdrawn by the federal government through the central bank and the DMO in the first 6 months of this year. So, and even if you take, like what the government said, we're trying to take out liquidity that was injected by ways and means. The Buhari government in 8 years injected 22.7 trillion naira by ways and means into the economy. The Tinubu government in the first 5 months of the year of its administration injected 7.3 trillion naira into the economy by ways and means. So that's what 30 trillion naira was evicted over a period of 9 years. If you take out of the 30 trillion, you take out 19.4 trillion in just 5 months, you can see why it's inevitable you create economic instability in terms of liquidity availability, in terms of cost of funds, in terms of availability of credit. This is just to show you graphically what the the DMO had taken. I've mentioned this extensively. Let's just move forward. And then in the Eurobond market space, of course, when your liquidity in your foreign currency, your external factors get weakened, the market will punish you by asking for compensation of risk in holding your debt instruments. So our Eurobond rose to a yield of 9.98%, which means the price came down and yield went up to 9.98%. That's almost 10%, which also why the federal government will struggle to come to the market now to issue new Eurobond, given our external factors. Let's quickly look at the outlook as I wind down and our investment strategies. One, interest rate, we expect, interestingly, I had said this indirectly, the high cost of fund is negatively affecting the real sector of the economy. So what I have said here is that the immediate complaint by real sector operators on the effect of high interest rate on their business viability has turned into a wailing, with the biggest industrialist in Nigeria, Mr. Aliko Dangote, openly for the first time in history, complaining that the current high interest rate environment is stifling productive activities. Of course, if Dangote speaks, then the government must hear. And that statement was made in State House in Abuja. And the governor of Central Bank immediately, on Saturday, the 6th of July, responded to it through the Deputy Governor of Financial Stability, when Mr. Philip Ikazo, who said that the Central Bank will soon be able to slow down increases in the benchmark interest rate. So anybody who has borrowed knows the implication of paying interest at 30%, at 5%. But a deeper look, which I had mentioned earlier, on a month-to-month, the inflation rate shows that they were seeing a deceleration in headline inflation within the last 3 months, which is month-on-month when you look at the change. Based on these factors, we are projecting a moderate hike in interest rates in the next 6 months. We think the central bank will at best increase the benchmark rate by 75 basis points from the current 26.25% to 27%, if it's able to do that, if it can even do that. So if it does anything higher than that, the economy will tip into a negative growth territory. Our position is further reinforced by the significant reduction in the amount of treasury bills sold by central bank in June. Central bank has already seen that it has moved up so much liquidity that the private sector is struggling for bread. It's asking to be allowed to breathe. It said the private sector is actually saying it can't breathe. So you saw in June, the central bank moved up only 617 billion by way of sale of treasury bills, despite the fact that in that month of June, there were 3 auctions. And then compare that to about 913 billion that central bank moved up in 2 auctions. That's 2, not M, just ignore the M. 2 auctions in May which means that central bank is also moderating the amount of money taken out of the financial system. On inflation, we think headline inflation will start to moderate in second half of this year. But like I said, there is a difference between disinflation and deflation. Disinflation is that the inflation is increasing at a slower rate. This deflation is that prices are coming down. We don't expect a deflation in the economy in the near future, but we expect that there will be disinflation in the coming months. And what are the upside risks of inflation moderating? These are underpinned by upcoming harvest season. We're entering the harvest season. In fact, my mother has been sending corn to us, and guess if you have a mother, she'll be sending corn to you. And then we also, government has just announced that they're going to suspend taxes on some food items, and we're beginning to see some relative stability in exchange rates, as well as you and I don't have money to buy. So if you can't buy, the importers can't import. If they can't import, there won't be pressure on exchange rate. If there's no pressure on exchange rate, depreciation of the currency will remain relatively low. On the converse, there are still a downside risk on inflation worsening. And those high downside risks are based on the fact that the government has said there is actually subsidy of over 5 trillion. I think it was one of the routers that said the federal government is owing about $6 billion arrears for food imports. And I know that the government is trying to increase fuel price. So if the government should increase fuel price, then the inflation rate projected, that our projection of inflation rate will not be realized. Of course, there's also issue of wage award. Unfortunately, interestingly, the labor unions are now admitted in their campaign for increase in their wage, unlike when they are threatening fire and brimstone. So we need to know what happened when they travel to Geneva or Switzerland with the government. And that's not the topic of this discussion. On exchange rate, we think exchange rate will remain relatively within a cycle of 1,700. We think we project a support level of 1,700 for the rest part of the year, which means we are saying that Naira is not likely to depreciate above 1,700. I'm sure you will have read in the newspapers today that the GM of NNP said they're going to borrow another 2 billion Naira to support their operational activities. And that, if they borrow it to come into the economy, and then all be part of what we had to stabilize the exchange rate. I'd also mentioned to us that we saw a trade surplus of 6 trillion Naira for a long time. We've not seen anything like that. So if the trade surplus, because you and I can't afford to buy anything, if the trade surplus continues, you're going to see a creation in foreign reserve. What are the outlook? The equity market, we think the equity market will suffer some level of price corrections. The price correction already started in the second quarter of this year. The factor that will drive equity performance this year are corporate earnings and yield on alternative fixed income instruments. In terms of corporate earnings, we think the economy has been very difficult for this sector operators in terms of cost of energy, low consumer demand, high cost of borrowing, and these things are going to affect their profitability. So we think that the reports or performance reports or income reports by quoted companies will be weak when they begin to announce their half-year results. And we also believe that yield on fixed income instrument will remain elevated in the second half of this year. And therefore, this will make investors, portfolio managers to continue to underweight their portfolios in equities and overweight them in fixed income instruments. So we expect further market corrections in the second half of this year. In terms of fixed income yield, with a yield environment of 18 to 26% on federal government debt instruments, which are considered risk-free, we think investors will continue to put their monies in fixed income instruments. Though we expect that this trend, the trend on issuance of federal government bonds and federal government treasury bills particularly, will moderate in the second half of this year. To circumvent the high lending costs, many corporates, particularly mid-sized companies, are coming to the market to issue commercial papers at a rate region of 30%. Our advice to investors that you need to be more circumspect in your choice of investment instrument, particularly commercial papers, as we believe that some of the issuers may not have the liquidity to redeem them at maturity. What are the playbook? What should you be doing? Focus on fixed income instrument. Prioritize your money market and bond investments due to their high yields and low risk compared to equities. Select equity instrument. For those investing in equity, focus on defensive stocks. Cowry is available to guide you. And bellwether sectors such as agriculture and oil and gas sector. And then diversify your portfolio into foreign currency instruments such as Eurobonds, dollar notes, and Eurobond mutual funds. We all have all those instruments here. And then maintain strong liquidity position to take advantage of bargain opportunities. Today, you're going to see real estate properties on fire sale. You're going to see assets on fire sale. If you maintain strong liquidity, you take advantage of them. Thank you all.
Thank you very much, sir. That was a very insightful presentation. I missed the review and what we should look up to in 2024. I hope our viewers are able to, take one or two things that would help them in making good investment decisions and how to further well prepare for the remaining half year and then what to look out for. So I would quickly dive into the question and answer because of our time. So I will just take them, the ones in the question and answer chat box. Okay, for those requesting for the records and the presentation, we would send via your email address. We all have the email address of all participants. So we'll be sending them to your email. Do not worry, we would send them. So I would like to take.
There are also people who have raised their hand and they've been raising their hand. I think you can call them to speak if they need to speak. I think there's a Haruna, there is, I think 4 or 5 of them have raised their hands before you go to the questions.
Okay.
Or 6 persons have raised their hand. If you can call their name so that they can speak quickly, they just give them like 20 seconds to speak. So Joel Haruna, can you speak?
Auntie, please help with unmuting.
Oh, you can unmute. You can unmute.
Okay.
Yeah, sorry, I raised my hand in error. I mean, it wasn't. I wanted to be sure that we're going to get the recording and the presentation, which has been addressed already. So thank you very much.
Okay, thank you very much, sir. Okay, so I'll just go right into the question. Seeing that Nigerian debt stock is high, is there a possibility that Nigeria's debt rating will be downgraded to junk territory, as Moody has done with Kenya recently?
No, I don't think so. Your debt rating will be downgraded to junk territory if your revenues are not strong enough to meet your debt obligations. So, but Nigeria still have reasonably enough revenues to meet the debt obligations. The challenge of our debt is particularly the commercial debt, which I mentioned earlier, about $15.15 billion. The multilateral debt of about $20 billion will not be a problem. The $15 billion you owe the World Bank Group is a concessionary loan. The $2 billion you owe IMF will not be a problem. Of course, you also owe China another $5 billion. But in terms of ability to pay service and debt, I don't think Nigeria will in the immediate future, unless we continue on this trajectory. If we continue on this trajectory, of course, we're going to run into a problem.
Yes, sir, thank you. I would like to call on Mr. Sunday Hayim to speak, please. Kindly unmute and speak, sir. Okay, while he's getting ready, Davis, okay, there's also an Elima whose hand is up. Please, can you speak, please?
Hello, good afternoon. Can you hear me?
Yes,
we
please,
can hear
go
you. Good
ahead.
afternoon.
Excellent, good afternoon. Thank you very much. I don't think I was the person to speak, but I think the other person is not ready yet. So first of all, just to say, I am an academic and I do a bit of work in this field. I'm very, very impressed to hear a Nigerian speak so honestly and so authoritatively on a subject that I don't see that a lot of Africans are able to discuss in such depth and with such time. I was enjoying it so much. I wish we actually had a lot more time to hear what he had to say. So thank you very much, Mr. Chiku. Just a quick question. You have mentioned that India and China are growing fast, but you didn't, in your playbook, refer to the possibility of investments in these economies. Do you want to explain why? Thank you.
Okay, I did mention, thank you for the compliments, Eliman. I did mention that in terms of investment, we're seeing a reverse flow of investment from China to the US. But then we are seeing a lot of investment flow to India, investment flow to the likes of Vietnam, Thailand, but particularly India. In terms of India, India is modernizing the economy in terms of infrastructure build. So we're seeing a lot of capital inject going into it. But China, the good thing about China, China's economy has gotten to a point where internal investments or domestic investment is enough to continue to propel its economic growth. And then China has tweaked its economy away from export-oriented economy to now a domestic consumption-oriented economy. So even given that they are a population of 1.4 billion, so even when they don't export, their demand, local demand in China is enough to sustain economic activity, which is why the People's Bank of China is very wary of having a financial crisis emanating from a possible real estate crisis. And that's why they are reducing their benchmark rate, they are reducing liquidity ratio so that banks will continue to lend to those sectors. And they are also trying to see if they can agree on some level of structure in accommodation to ensure that those loans don't go completely bad. But in terms of investment, the Chinese economy has now grown to the point that domestic investment is enough to sustain economic activities. The economy still grew about 4%, sorry, 5.4% in the first quarter of this year. But in terms of investment coming from Western countries like we used to have, that in reverse, and some companies are moving away back from US to US because of lower energy cost. And I guess you need to take a cue from this. We have been focusing on increasing the tariff on electricity on Band A. Today, our tariff is higher than what obtains in countries like US. So if we have that level of tariff, then the cost of energy, which is a major input cost for manufacturing, will make our manufacturing activities uncompetitive. The advantage we think we have in terms of skill level, in terms of size of workforce, does not translate to skill level.
Okay, thank you very much, sir. I hope that answers your question, Halima. Okay, so I'd like to quickly call on Dr. Kabiru Hamzat to speak. Dr. Kabiru Hamzat, are you ready?
No, you mean Victor Obo, please.
What did you say?
Okay, I'm ready.
Okay, sir, please go ahead.
Okay, good afternoon. I still want to pass another compliment to the presenter. Like I said, very superlative and robust. In fact, we are proud of you. Now, my question is simple. We heard from the presentation that cost of living crisis can lead to civil unrest, even insurgency, like we experience in Nigeria. So I want the presenter to tell us, what do we think we can do in simple to just overrun this crisis, this cost of living crisis, especially in the country? Thank you.
Okay, thank you, Dr. Hamzat. A couple of things. One, the core problem we have is coming from food inflation at 40.66%. And principally because we have insecurity in the major food base of the country. There's a certain point that we know our problem, we need to address the issue of insecurity. The government has the capacity to deal with this insecurity situation. It's just started as a small play in Northeast, in Borno State. And then it has spilled over into Northwest, and then we are dealing with Northeast, Northwest, and North Central. So the government needs to address that. The measure they've taken to reduce, to eliminate or suspend subsidy on the likes of importation of rice, importation of some food items, will act as a palliative. But you need to also deal with the exchange rate, because the exchange rate is another challenge we are dealing with. Because if you still import these food items at higher exchange rate, then they will still land on the kitchen, on the stores of our shops, of our stores of our families, in the kitchens of our families at a high rate. So the other thing that government needs to do is to make sure that we maintain exchange rate stability. And that will come so that the pass-through effects of imported food items will not exacerbate our cost of living crisis. And for the government to deal with the issue of exchange rate stability, we need to improve crude production. If we improve crude production, which accounts for about 90% of our exports, then we will stabilize the exchange rate and possibly see a Naira gain. If Naira should gain back to the region of 750 Naira to a dollar, we will immediately deal with this cost of living crisis. So government must avoid a further increase in fuel price, in as much as free market economic thinking and suggests we should do that, because Nigerians can absorb another major shift in the cost of transport and cost of food, which will have the impact of a further increase in fuel price. So the government must do something to improve food production. And because most of the food items that are problems we have take gestation period of 3 to 6 months. So if government deal with insecurity, you're going to see yam tubers. Rice is being planted now. What they call the paddy rice is being planted now. By November, they'll be coming out. I mean, the nurseries are being planted now. So in terms of transplanting will take place in the next 1 month. So if they are planted in August, by November they are harvested. Maize takes about 3 months to harvest. Yam takes maximum of 4 to 6 months to harvest. So we can actually, if we deal with the issue of insecurity, restore some level of food security in the country in a matter of 6 months.
Okay, thank you very much, sir. So Olalere Babashola asks, banks are coming to the market to raise funds to recapitalize. We've been through this road before, and banks thoroughly scammed investors. Why should we trust them this time and be beaten the second time? Which bank stocks would you recommend? Don't tell me all of them are good.
Okay. Well, what I would say is that the banks are not coming to the market because they willingly want to come to the market. They are forced to come to the market. The central bank said they should increase their capital base to 500 billion for those with international operation, 200 billion for those local operation, and 50 billion for those regional banks. And the central bank also said that the reserve which they accumulated over time would not qualify, and then they are forced to come to the market. So it's not as if they want to come to the market. This is a matter of compulsion. In terms of which bank I will recommend, I will only say that we have advised, one of the banks we advise is Fidelity Bank. We're involved in advising them. We were involved in determining the price at which they come to the market. And when we looked at their performance, their share price performance, in 2021, the stock price was about 2.55 kobo. In 2022, it was 4.35 kobo or so. In 2023, it closed at 10.80 kobo. And they are coming to the market at 9.75 kobo for the public offer. We were involved. So that's the one we had an insider knowledge. And that's the one I can speak on without saying let me consult. But if you want or to speak with any other of the bankers stock coming to the market, you can consult us privately. We'll take a detailed look at it and we'll advise you.
Okay, thank you very much, sir. Adewale Anthony Adedokun says, how sustainable is the elevated yield in the fixed income market? For how long can the federal government sustain the high interest rates on the treasury bills? Also, what is the effect of the bank recapitalization on the banking stocks in the short to medium term?
Okay, for how long the federal government will continue to sustain the elevated yield? It's already a lot of weight or burden on the federal government. The government, like I said, had borrowed about 19.9 trillion. So if you take an average of 20 trillion, I said government has borrowed 20 trillion at 20%. 20% on 20 trillion will give you 4 trillion. As of November last year, federal government debt service as of September last year, federal government debt service was 5.7 trillion. So if you add another 4 trillion to it, you are talking of in the region of 10 trillion as debt service. Remember that government revenue this year, projected revenue is far just about 12 trillion or so. Yeah, about 17 trillion. So in effect, the government spends 10 trillion to pay interest. Then you can imagine that the government won't have any headroom to do anything. So I think in terms of cost, the burden is so much, but the government is contending with exchange rate stability. So it's a very delicate balancing act the federal government is trying to deal with, which I had said earlier that I think we should begin to see a moderation in terms of volume of treasury bill sales. In May, it was 913 billion. It dropped 617 billion in June. So I also think they would consistently drop the volume they are borrowing from the public. So in effect, the burden is already exacerbating pressure on them.
Okay, thank you very much, sir. We'd like to take from those raising their hands, we'd like to take Victor Ikem. Please speak, sir.
Okay, good afternoon, everyone. I already submitted a question, but my question is, given the new Ministry of Livestock created, aside of the politics, do you think this would bring down the cost of, or address some of the cost issues related to food and the rest? Thank you.
Okay, what I would say is that in terms of Ministry of Livestock, the key thing is that we need to encourage ranching. Elsewhere in the world, the volume of meat we consume here is an insignificant fraction of what the US consumes. But you won't see any cattle anywhere roaming around. So we need to increase the issue of ranching. We need to increase the quality of feed we give to this cattle, so that the yield, their yield in terms of protein yield will improve, and the cost per kilogram of meat will also reduce if we have a proper ranching. So I don't know what the Ministry of Livestock will do, but the solution to our meat problem is ranching. And even if the government wants to subsidize that form of farming, it can subsidize it if it's ranching. Then you have some level of control, you have some level of identity, you have in terms of location, ownership, and all those things, and size of their cattle. So, but meat is one of the several food items that whose prices have gone up. The major staple food items are the tubers and the cereals. We need to address the issue of the cereals and the tubers to reduce the cost of living crisis and improve on food inflation.
Okay, thank you very much. Chima Ejide, can you speak, please?
Hey, good afternoon, sir. Hello, can you hear me?
Yeah,
Yes,
we can hear
please,
you.
go ahead.
Good afternoon, sir. Nice listening to you as usual. Okay, so although I actually sent in my question, but then it's basically as regards one of two things you've said earlier on here. So because like considering the way the stock market is basically reacting to this right issue and public offer, I want to know, what do you think? Do you really think the recapitalization is ill-timed? And then secondly, I noticed that when you were doing, I think the last slide, you talked about the focus should be on the oil and gas and then the agricultural sector. So you notice you left out the banking sector. Is there a particular reason why you decided to choose just the oil and gas and the agricultural sector? Thank you, sir.
Okay, in terms of timing of the offers, because they were given, like I said, this was a compulsion. They were not compelled to come to the market and raise money, and they were given 2 years to achieve that. So they had no choice. They have no choice than to come to the market, whether the market is the most auspicious now or not. So we need to recognize that. So it may not be the most auspicious time for them to come to the market. I remember, like I also said in my presentation, most of them are coming to the market by way of right issue. Which means they are selling to the existing investors. The implications of that is that remember, liquidity flows from the banking system. So, and the owners of the banks are directing liquidity to themselves. So it then means we are not going to see a lot of Naira vote in secondary market of the equity space. That's you have to be recognized that. In terms of why we did not mention the banking industry, I said earlier that the banking industry was only sector in the face of the year that actually declined. It declined by about 4.31%. And that trend is going to continue in the coming month because investors are cautious of the fact that the banks are going through a recapitalization process, and that even if they make profit in the current year, many of them, because those profits may be allowed, admitted as part of their capital that meets their new capital requirements. So many of them are not going to be bullish in terms of payment of dividend. And remember, investors are attracted by benefit payments in terms of dividend payments. So the banks will adopt very conservative dividend policy in the next 1 or 2 years until they meet this new capital requirement. So that's why we do not think the capital gain opportunities in the banking sector is very pronounced. And that will focus on the bellwether sectors, the oil and gas sector, and then the agricultural sector.
Thank you, sir. Dazie Opara, can you speak, please?
Yeah, you can hear me now?
Yes, please go ahead.
Okay, good. Yeah, let me first identify myself with the compliments of earlier participants to the presenter. Beautiful presentation, beautiful graphics, beautiful elucidations. My 2 questions quickly for me, even though in part the one has been answered when you mentioned Fidelity. You said oil and gas doing so very well, relatively, but banking not quite well. Yet the banks are in the public domain, making of us. But you've given your reasons why you think Fidelity may be there. Thankfully, we have something to do with Fidelity through my wife. So I think we're on the right path. But the one still lingering is the issue of inflation. To note that, or really see apparently that my salary now can only get me about 56% or so of what it got me last year. And now unions are clamoring for minimum wage. So in your professional opinion, do you think that the evolving ding-dong about minimum wage, if they get it 250 or whatever, would it help or hurt my purchasing power? Thank you.
Okay, thank you, Prof. The first thing I would say is that today we are dealing with major erosion in purchasing power or net income of households. So any improvement will at best restore them to their consumption level or their standard of living level. So as we speak today, there is a huge gap between the income of salaried workers and their household consumption needs. So it will not worsen it. The only thing that will happen is that if there is no commensurate improvement in food production, then we're going to see part of that increase in earnings or salaries and wages of public sector employees eroded by further increase in food prices. But I had mentioned that the government does the right thing. We can address the issue of food production within the next 6 months because of our cycle. Our farming cycle is very short. So having said that, there is a need to improve the earnings of, or to replenish part of the erosion in earnings of public employees or all of other earning salaries. Because I did mention that if your salary was the same since May 2022, then you can only afford 35%, not even 65%, 35% of the food items you afforded then. So any improvement in that earning will help us reduce the cost of living crisis, provided that there are also efforts to improve food production so that it is not eroded by all of us demanding for additional food and then paying more to buy those food. And once again,
Okay.
thank you for the compliment, Prof.
Okay, thank you very much. I'd like to quickly take this question from Chiwendu Obianyi. Trade surplus came in at 6.5 trillion in Q1 2024, while export has dominated by crude oil. Past government has clearly called for diversification, but we still look to crude oil to aid our economy. To consolidate on this, especially in the area of FDIs and FPIs, what can this administration do in terms of effectively sticking to other area of exports apart from crude oil?
Okay, if you look at the export graph on export, you will realize that sesame seed accounted for 1%, then processed food, processed food export accounted for 1%. Then it then means that it's just that we are not producing enough of the local food for consumption. So ordinarily, you can see there are also export items that there is a market demand for it, but we are not producing enough. Assuming we're producing enough of the food items, a lot of food, Nigerians in diaspora still prefer Nigerian food. So there's still a window to export food. And then food like yam tuber is consumed in several South American countries. So if you produce enough of yam tuber, you can actually export them to Brazil, Cuba, Venezuela, and many South American countries. Even in the US, you can still see that. You can, if we're producing enough rice, there's a huge export market for rice. So in effect, there is a window for us to export more even unprocessed or what is called extractive industry items so as to stabilize our foreign exchange earnings. In terms of foreign portfolio investment, if you continue to offer instruments at those yields, you will continue to attract capital, but those capital will reverse in less than 1 year. So you have to ask yourself, where will I fund the reversal? So in as much as attracting foreign portfolio investments to use to stabilize your exchange is advisable, it must be done in conjunction with efforts to increase your operating cash flow, and operating cash flow will only come from crude oil. And we can address the issue of crude. The government has resolved the issue of surplus acquiring mobile, which is why we saw that increase in the oil and gas sector by 11%. So those measures are supposed to incentivize improvement in crude production. And it's only when you have improvement in crude production. But for us to do that, we have to deal with the issue of insecurity in even Niger Delta areas where pipelines are breached at regular intervals. And then when they are breached, crude oil is stolen. And that has driven away virtually all the oil majors from our onshore and shallow offshore assets. So we need to address that. So even the local investors who are taking over those assets are not going to lose all their production to theft.
Okay, thank you very much. I would like to take Elijah Akani. Kindly speak, please.
Okay. All right, thank you so much. I also want to join other speakers to appreciate the presenter for a job well done, which is why we always look forward to listening to you. My question borders around exchange rates stability, which in your presentation, you made mention of a $2 billion loan from that NNPC is applying for, which we are hoping that when that inflow comes, that sum will be used to stabilize the exchange rate. Now, my concern really is the sustainability of this kind of approach of stabilizing exchange rate. For how long do you think that a $2 billion will stabilize the exchange rate? Isn't this a kind of quick fix, approach to exchange rate stabilization? And can one really make a serious investment decision, based on this kind of stabilization, especially when you don't know for how long can this be, how sustainable can that amount sustain exchange rate, and for how long will it do so? Thank you.
Okay, thank you, Elijah, and thank you for the compliment. What I would say is, with respect to stabilizing the exchange rates, the borrowing and including any inflow from foreign portfolio investors that we witnessed are all stopgap arrangements. Like you said, they are palliatives. It's just like when you have a fracture, the first thing that they give you is they give you pain relief to moderate the pain or numb the pain, and then, but they still need to operate on that. So we still need to address the issue of operating cash flow. We need to focus on how do we, in the short term, the only route to our resolving our exchange rate crisis is improving crude production. Remember, I had said that our average crude production is about 1.25 million barrels a day recently. Of course, if you add condensate of about 200,000, you go to about 400, 450,000, 1.45 to 1.5 million barrels. But our projection was 1.78 million barrels a day. And if, like we have done before, this country had produced more than 2 million barrels a day in the past. At some point, the government, the target was to achieve 3 million barrels a day. If we should achieve 2 million barrels a day, we would just be fine because we will earn enough income to meet those even short-term borrowing as they fall due. We earn enough income to stabilize our exchange rates and possibly see appreciation in local currency without addressing the issue of crude production. Everything we're doing are stopgap measures, they are temporary reliefs, and they will only tide us through some period of time, but we need to resolve the issue from the fundamental problem.
Okay, so we'd like to take Onyechi Bemere.
Roger, you also raise your hand, though. You can lower your hand.
Okay. So please, Uche, can you speak, please?
Yes, good afternoon. Pastor Johnson, you've done very, very good in touching major sectors of our economy. I am really pleased with all that I have heard. Some of the things that, I ponder is, how do we really get it right? The issues of lending, cost of money. You talked about even renewable sector. In most of the civilized world, you want to get a solar system in your house, in your residence, in your office. You don't need to bring out $30,000 or $40,000 upfront. You simply, of course, if you have a good name, good credit, you sign a dotted line and they come and install the thing, and then you're making payments. Those are the kind of things that I really believe that can help drive this economy. Lending, mortgage sector. What is the issue? Why can't we get it right? Everywhere else they are talking about 5% to borrow money to buy a property, to buy a house. In Nigeria, to borrow any money to buy a property, they're talking about 30, 35%. Sir, what are the things that you think we really can do to get our sector right so that we can begin to stir up our economy and make things work for our citizens? Thank you.
Thank you, Pastor, and thank you for those compliments. For us to get it right with our interest rate environment, two things must happen. One, the policy environment. Two, the inflation rate environment. Ordinarily, those countries you mentioned are talking of 2% inflation rates. They tell you that above 2% inflation rates, the economy begins to suffer, productive activities begin to suffer. But we have consistently maintained inflation rates above 10%. In the past, because it wasn't always the case, at some point we were having an inflation rate of 9% or less than that. The CBN inflation targeting was actually 9%. And if the government, which side the public sector is very critical, I have mentioned in my presentation that two instances, public sector announcements and policies that shaped, in fact, three instances, issue of a transparent auctioning of GSM licenses that led to a sector that was inconsequential to 18% of the GDP, issue of pronouncement on the banking capitalization that led to the banking sector, which was one of the bellwethers in the past, declining by 4.3%. Issue of government announcement or compelling NNPC to pull back from its insistence on being preemptive rights on mobile acquisition that led to oil and gas sector appreciating by 11%. So these are how critical government policies are. It is government policy that we need to do, address the issue of food production, you bring down inflation rates materially. Stabilize the exchange rate, you bring down inflation rate further. If you do those two things, then you're going to have inflation at sub 10%. And inflation of sub 10%, banks will lend. Sometimes we forget that between 2005 and 2007, this environment witnessed a very high rate of consumer lending. Banks were going to people and said, you just gotten a job, you have your offer letter, and they give you money to furnish or rent a flat and furnish a flat. It happened in this country, 2005 to 2007, under Basande's government. And banks were lending at 10%, 9%. Banks were lending money for people who want to buy cars. But if you go to go and buy a new car, then it comes packaged with consumer credit. But unfortunately, those factors have changed because of change in leadership and policy environment. So if we get right with leadership, get right with policies, we should go back to those areas of low interest rate that will incentivize consumer lending. Ideally, it's difficult for people to fund a lot of things from their equity savings. So if you have to have a fast-growing economy, you need consumer credit. And consumer credit will not be there if inflation rate is at 33.695%, if interest rates, MPR is at 26.25%, those things have to reverse. So the key thing is at the policy level, a lot has to be done from that perspective.
Okay, thank you very much, sir. Because of our time, we'll take the other question and answer offline. So before I quickly introduce my colleague Yusuf to speak on the fidelity rights and public offer, I'd like to quickly state that for those joining us for the first time, I'd just like to quickly talk briefly about Cowrie Asset Management and what we do. Cowrie Asset Management has been around for over 18 years. We are licensed and regulated by Securities and Exchange Commission as a financial advisor, issuing house, and venture capital manager. Our services cuts across investment banking, portfolio management, fund management, securities dealing, and the likes. So for your investment journey, please feel free to speak to any of our customer service representative. You can go to our website, www.cowrieasset.com, for more information. We are in Lagos, Port Harcourt, and Abuja. So for your investment journey, according to what the presenter has said, to focus more on the money markets and bond investment, please reach out to us. We do portfolio management where we help you, guide you through your investment journey as to what and when to start. We look at your risk tolerance and your investment goals in achieving this. And for diversification as well, we have our mutual funds. Currently, it's doing about 9 to 17% per annum, and our Eurobond fund as well, which is the dollar-denominated fund. So please feel free to reach out to us. Thank you very much. Yusuf, please, you can go ahead. Thank you.
Hello, good afternoon once again to our viewers. We appreciate you being on the call with us. So as we've heard from JC about the world economies and our own economies as well, we need to manage our own personal economy, whether we like it or not, because Nigerian, we all know what is happening, but Nigeria is still able to keep afloat today because of our external reserve, because of the investment we have all over the years. So what we are saying is that no matter what the economy is saying, no matter what the challenges today, we still need to manage our investment. We still need to manage our cash flow, whether we are working, whether we are doing business, no matter our cash flow, whether it's surplus, whether it's moderate, whether it's lean, we still need to set something aside for tomorrow. Tomorrow can be medium, can be long time. So as my colleagues rightly mentioned, we have Naira investment, we have dollar investment for those that want to manage forex exchange risk. So for those that have dollars, we have euro bonds, we have dollar fixed deposit that you can put in your money with good returns. And we also have mutual funds. All these are regulated by the Securities and Exchange. So we have custodian that actually will hold those assets in your favor. Also, the fixed deposit is there. Traditionally, we all know fixed deposit, but today it's been broadened up. You can still take part in the TBs. We all know what TB is doing now, up to 15, 17, 18%. We can do it for you at retail. Normally, the standard size is supposed to be 50 million, 100,000. But if you have 500,000, 1 million, 2 million, can also take part. So we have evidence service bond, we have CPs, also bond. So to actually have good investments, we have some opportunities in the market today, in which carry is also a player to it. We have the Fidelity Bank offer that's going to close on 29th of this month. They are doing a combined offer. That's the right issue for the existing shareholders at 925 kobo, and the offer is at 975 kobo. So it's part of investment. You just need to, as I earlier mentioned, no matter what the economy is saying, you still need to keep part of your income, your cash flow for tomorrow. The simple example I can give is, let's assume we don't have this pension managing our part of our salary. Everybody will have finished spending all his salary on monthly basis on the excuse that the economy is not doing fine. But if you look back or you receive your investment alert for your PFA, you smile. So same thing, we can be doing it personally. Open equity accounts, buying shares regularly. The Fidelity Bank is on. Then also, the Access Bank also opened on Monday, just this week, and it's going to close probably in 3 weeks' time. It's not a combined offer, it's just a light issue for existing shareholder. It's being sold at 19.75 kobo, 1 for 2, meaning that if you have 10,000 worth of units of shares, you are entitled to have take up 5,000 units at 19.75 kobo. So more banks will still come to the market, and as JC rightly mentioned, it depends on your investment objective that will actually decide what equity you need to buy. And if you come to us, we're able to profile you, we know your investment objective, that we're able to choose the right investment asset for you. It might not even be equity, it might be CP you need, it might be treasury bills you need, it might be other forms of asset class that you need. So you can contact us for further details. Thank you so much. We appreciate it.
Okay, thank you very, very much. I also like to add to it in respect of our Fidelity offer and the right issue that is going on, which we are part of it, like our GMD mentioned. So for you to be able to take part in the public offer is just 9 naira 75 kobo, and the right issue is 9 naira 25 kobo. So you can submit through us, we can guide you accordingly as to whatever you may want to know about it. So thank you very, very much. I would call on Aike to give us the vote of thanks.
Okay. Thank you, everyone. Thank you, all the participants. And we really, really appreciate the time you've taken to be part of this webinar. And we believe you've actually gained so much from it. And we really appreciate the comments, the questions especially. And I want to also add that all those that ask questions will take our time to answer those questions and reach out via the email that is stated on your registration. So be rest assured we'll address all your questions. And I also want to thank the panelists, and most especially our GMD for a well-delivered presentation. Thank you, sir, for your contribution and your commitment to this. Be rest assured we'll be having another one in the next quarter, early period in October. I will inform everyone about it. And to also onboard, as you are getting, there'll be an email to everyone that has participated. You have an opportunity to also onboard on Cowrie. The depth and the wealth of knowledge is unarguable. You can take advantage of this team to manage your investment, and we are here for you. Thank you and remain blessed. Thank you, everyone.
Thank you. And for those of you like Nado who is still raising his hand, please just post your question on the chat and then we'll come back to you. Thank you all for joining us. We hope to see you in October later this year. But make sure you have a relationship with us so that you can always reach us anytime and we'll provide you our services, our topmost services.
Thank you very much. Thank you, everyone. See you in October. Thank you.